Good morning and welcome to this Wednesday, May 10th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, one inflation report has come and gone. We got the April CPI data out this morning. Both the headline number and the core number came in as expected. Might not seem like much, but I think that was good news. Right now, anything that's not bad news is good news. When you're in a bull market advance, which I believe we've been in now throughout 2023, we've seen the VIX dropping down well into the teens. That tells us that the market is in a position to handle bad news better than it was before, but it loves good news or even just okay news. And so immediately we saw futures flip. Futures were down heading into the CPI report this morning, and now they're up decently. Let's take a look at those futures. So currently I'm showing Dow futures up about 180, S&P 500 futures up 32, NASDAQ futures up about 112. Crude oil prices up 8 cents, getting close to $74 a barrel, and the U.S. 10-year Treasury yield, lots of buying in bonds going on this morning after the tame inflation report. We see the 10-year Treasury yield down about 6 basis points. Of course, the yield moves opposite prices. So when prices are going up, yields are coming down. And the opposite holds true as well. When prices are going down, it means yields are going up. So when bonds are being sold off, yields go up. When bonds are being bought, yields go down. So this morning, we're seeing bonds being bought with the yields lower, still within the same trading range that I've been talking about, though. So really no big shakes there. Let's go ahead and jump into the action yesterday, and then we'll talk a little bit more about inflation. Let's see. All right. Dow Jones Industrial Average down 57 points yesterday. S&P 500 down 19. NASDAQ down 77 on a percentage basis. NASDAQ hit a little bit harder. Of course, the NASDAQ's been right up there flirting with the highs from the last few months. It's actually put in a couple of new closing highs, but just barely. We were down, like I said, pre-market, but now it looks like we're going to jump to some new highs on the NASDAQ 100, and the S&P 500. I keep talking about 4179. We're probably going to open up fairly close to that level, maybe not quite up that high, but I do think we could be challenging it before the day's out. We'll see whether or not we can confirm a breakout and a close above 4179 there. Mid caps yesterday were down 9, small caps were down 7. So they were kind of in line with the NASDAQ for the most part, NASDAQ and the S&P. The Dow was your best relative performer yesterday, losing only 0.17%. Looking at the sectors, only 2 were positive. So we had industrials, which were up just a little bit more than 1/5 of 1%, and energy barely up just 3 pennies. That was 0.04%. To the downside, we were led by materials, which dropped almost 1%, down about 0.9 of 1%. Technology down about 0.75 of 1%. Healthcare down about 2/3 of 1%. Those were the groups leading to the downside. Keep an eye on technology. And the reason I say this one is really simple. It's 27% of the S&P 500. It has been one of the top 2 sectors this year. That one and communication services has been there. Those have been your 2 strongest sectors. And technology, because of its weighting in the S&P 500, another confirmed breakout would be very bullish, not just for technology, but for the S&P 500. If we want to get through that 4179 level, this is the best group to do it. If technology is rolling, chances are the S&P 500 will follow. Moving to the 10-year Treasury yield again, the April CPI out this morning, and it showed basically what the market was expecting, which is good. We didn't want any bad news. We didn't get any. The March CPI, the headline number, came in at 0.4 of 1%, rose 0.4 of 1%, exactly what was expected, even though it was higher than the March number. March number, I believe, was plus 0.1%. I'm doing that off of memory, so I'd have to go back and double check it. But it was a pretty big step up, but it was expected, and that's fine. If we strip out food and energy and look at the core CPI came in at also rising 0.4%, which again was as expected. So I'd been talking recently about these numbers, saying that, hey, if we got a number that was as expected or better than expected, I thought the market would react positively to it. I thought if we were slightly above, maybe at 0.5%, we'd probably get a gap down, followed by more buying. And the only thing I really feared was something that was up, more like 0.6, 0.7%, something that would have been a little bit more shocking jump, because the Fed is starting to give us hints that they are pausing. I think they're ending, but they'll probably call it pausing, because they want to make sure the market understands that they will raise if they have to. But I believe it's the end, and I think we'll probably see rate drops later this year or in early 2024. I think it's going to happen later this year, because I believe inflation continues to come under control, and there are still signs out there that the economy is a little wobbly. And with an inverted yield curve, I wouldn't be surprised to see the Fed begin to lower that, to bring that inverted yield curve back more toward the flat line. But for now, here's the range. I've talked about it: 3.27% to the downside, and then probably about 3.65% to the upside. That's kind of the short-term, last 2 months range for the 10-year Treasury yield. And we're sitting almost squarely in the middle of it right now, 3.45%, now 3.46%. So really not a whole lot going on there, just kind of range bound for now. To me, the bigger move is, do we get back through that 365? And I would even give it gap resistance maybe to 370. So up in that range. To the downside, the recent low, 3.27-ish, right in that area. Which one breaks first? That really, to me, is what this comes down to. Do we break again to new lows to the downside? Is money going into bonds, sending the yield back down? If so, I think that is more and more of an indication that the bond market is telling the Fed not only to keep your foot on the brakes on these rate hikes, but you might actually think about putting it in reverse and begin taking away some of these recent rate hikes. That's the signal I'm getting from the bond market, and that certainly would be the signal if we get a breakdown back below 3.27%. You're not worried about inflation if you're talking about yields moving to probably at that point, what, a 7-8 month low. Hardly building in any expectations. I mean, it's really hard to say that bond traders are building in expectations for inflation if you have a yield that's down in the low threes. Normally, if inflation were a continuing problem, or if we thought it was going to be a bigger problem later this year or next year, bond investors are not going to get in to a 10-year Treasury yield at 3.5% if they expect inflation to be 6%, because you're losing 2.5% on your money. You would want to start building in those expectations. That was being built in 2021, 2022, back when the stock market anticipated all that. We always talk about the stock market looking out 6 to 9 months. And folks that are looking at the news now saying, well, the stock market's got to come down, you've got to go back and realize it already went down in anticipation. The S&P was down 28%. The NASDAQ was down close to 40%. What do you want it down? Want it to go to zero? It's all about perspective. We dropped when we got down middle part of last year. S&P was down in the 3,600s. I called a bottom, but really what I was calling was the fact that it wasn't worth the risk to be short anymore. The S&P had already dropped at that point 25%. It's about managing risk. It's not about being exactly right or wrong on the bottom call or the top call. It's about seeing those warning signs and adhering to them, listening to them. since those lows in June, September, and then of course the final low in October, market's been up. It's going up again this morning. Will it hold? I guess we're going to find out together. My suspicion is that we're going higher. Is it this week, next month, next quarter? I don't know. Short-term market can do anything it wants. But the signals are there. Been talking about them for almost a year now. Moving on to the S&P 500. So let's look at the chart and just see what's the chart telling us. And I'll go back first to the weekly chart, because if the bears want to hang their hat on something, this is the chart. This is the only one really for me where I'm thinking anything bearish. Now, first of all, we have to recognize that there have been some positive bullish short-term changes on this chart in 2023. Instead of trending down below the 50-week moving average, we went above it to start the year. We pulled back, we held the prior low, and now here we are up again. Another breakout would be a very strong signal in an uptrend. So where's the bearish part come in? Well, lower low, lower high, lower low, lower high, lower low. Right now, we have a lower high and a lower low still in place. Everything that's happened since October is within the boundaries of this recent, well, not quite so recent, last August, but lower high, lower low pattern. So it's been a very lengthy, nice recovery. I know the bear market strategy or philosophy at this point is we're going to roll back over and back down the new lows. And I wish you luck. Hey, market's got two sides. You can pick your side, see what happens. I'm going to remain on the long side. And that doesn't mean that I just stay long until it goes back down and hits 3,600 or 3,500. There are obviously some pretty key support levels on the way down. And there are a lot of under the surface signals that need to be evaluated. We're not just going to turn around one day, at least I don't think so, and be back at 3,600. It's going to be a process. It's going to happen over time. It would probably be somewhat violent, at least at the beginning. And you're going to see that on the chart. But how you can remain short while we've been going up for 8 months, I don't understand that. But that's the level from a longer term perspective that we all need to be watching. 4,300, I think maybe the closing high on a daily basis was like 4,305 or something like that. That's the level ultimately on the S&P 500. Now, looking at the daily chart, when I'm talking about 4,179, I'm talking about this right here. This was the early February high. This beginning of last week, we actually were above that 4,179. We had an opportunity to close above, to actually confirm that breakout. It's right there. Intraday, that little tail, we went up above resistance, couldn't hold on, and back down we went, back down to support. And now we're trending back in the middle of this range today. I don't know if we're up. Let me see what we're up. Right now, the spider is up 0.9%, 414.63. So if we take 0.9%, that is about 37 points. That's going to take us at the open to about 41.56, somewhere in that area. 41.79 is the level. Let's watch and see where we close today and upcoming days. That would be a nice breakout. And then we'd be left with that August high that I just went over on the weekly chart. And beyond that, I mean, I just think you're kidding yourself if you keep thinking bearishly, if we're back above 43.05. Actually, let's see what that number is. Yeah, 43.0520. So 41.79, then 43.05. Those are the two big levels to the upside. To the downside, I mean, you've got to at least get back down and close below 4,045 to 4,050 at a minimum. I mean, that's only a couple percent, less than 2% away, but that would just be a start. I mean, we did that once before, held the prior low, and then went back higher. So if we went back down below this 4,045 area, it would bring back into play potentially the 3775 to 3,800 level. Although there's lots of gap support, other price support that we could look at as well. My point is, we're a long way from what I would consider a major breakdown. We're not that far away from what would be a very significant breakout. So let's see what happens. NASDAQ 100, there's a couple of closes I was talking about where we got up above recent highs. Came back down yesterday, but today, right now, the QQQ is up 1%. We're at 324.81. So 1% would put us up another 132 points, which would be 13,333. 13,333, and we've got to get to 13,667. So we'd still be 335 points away, which would be somewhere around 2.5%. That's about where we're going to be when we open today, based on where we're trading right now. 2.5% away from that August high. That could be that could be today. That would be a big rally during the day, but I'm just saying it's not that far away. And you want to watch it. We'll get a breakout. We're getting leadership. The other thing that you need to understand is that the three most aggressive sectors are the three best performing groups in 2023. We're not being led up by energy or materials or any of the defensive groups. This is being driven by aggressive growth. Why in the heck would you want to get into aggressive growth stocks right before a big recession-led drop or right before a big inflation-led drop? You wouldn't. Wall Street is moving into aggressive areas aggressively in 2023. That's one signal that I don't know how anyone can ignore. But it is what it is. All right, so let's talk a little bit about chart of the day. I got a chart for you today. And if you like these charts of the day, go over to earningsbeats.com because we do have a EB Digest newsletter that we publish 3 times a week, Mondays, Wednesdays, Fridays. Don't let it fool you. It's not this lengthy newsletter. It's one chart and 2 paragraphs. But it's an educational piece that we like to put out, give back to the community, teach some of the things that I've learned over the years, and hopefully improve your trading process in the, throughout this newsletter and some of the topics that we cover. You do need to register with your name and email address. There's no credit card required, so you don't have to worry about that. You can unsubscribe at any time. So you might check it out for a few weeks and say, well, this isn't really doing it for me, or this isn't my style, whatever. No problem. No hard feelings. You can just unsubscribe. And you can do that, like I said, at any time. But we do get into a lot of things that are important to us: earnings, relative strength, gaps, candlesticks, price volume, trend lines, moving averages, and so forth. Those are many of the things that I'll be talking about in the newsletter 3 times a week, and it'll be delivered to your email probably right around the 8:30 time frame. That's what we shoot for. Try and get it out to you about an hour before the market opens. Anyway, I think it's a great newsletter, something that hopefully will help you in your trading or investing. It's not all trading. Sometimes the things we put in there are about market guidance, things that we use to help guide us in terms of calling tops and bottoms. If you've been impressed by the top I called in 2022, beginning of the year, and the bottoms, which were literally almost right on the bottom, I talk about the things that I look at. Make sure you sign up. Also, I'll mention too, anyone who signed up for this newsletter comes to all of our free events. We make sure we send out room instructions to anybody who is signed up. So it's another great way to attend valuable educational sessions that we put on from time to time. All right, so today in the EB Digest, I featured a stock, Carvana. And the reason I featured it, I'll go ahead and look at this up here, is if we view a summary of our short squeeze chart list. So we put together all the stocks that make up the top shorted stocks, the most heavily shorted stocks. We put them all in a chart list. So anything that's over 20% short, according to our source, is put on this list, and it's numbered 001, 002. Right now, there are 47 of them on here, all the way down to 047, and they're listed in the short percentage of float order. That's what this percentage is in here. So give a little bit more information. Now, Carvana is number 1 on the list. It has a short percentage of float of 56.46%. That's a really high number. And if you don't understand shorting and floating, let me give you a quick analogy. Let's say you live next to somebody and they've got a real old sports car, or I don't know, maybe they got a Lamborghini or something sitting at the house next door. And for whatever reason, you believe the price of those Lamborghinis is going to drop by 10%. Let's say that one's worth $300,000 and you think it's not worth more than $270,000. So what you do is you go over and you ask your neighbor, can I borrow your car? Now, neighbor's probably going to say no and think you're nuts. But in this example, they say yes, and they give you the keys. And so you borrow the car and you sell it for $300,000 because that's what it's worth today. You believe it's only worth $270,000. And if you're right, and the price of the car drops to $270,000, you buy it back. So you sold it at $300,000, you buy it back at $270,000, you made $30,000, and you take the car and the key back to your neighbor and return it. Thank you. Appreciate it. I really enjoyed borrowing that car. Same thing happens in the stock market. If you believe a stock price is going to go down, you go to your broker and you say, I want to borrow someone's shares. And they let you have them. And you sell them. But when you sell them, you're now adding to the short percentage of float. At some point, you have to buy those shares back and return them to whoever you borrowed them from. Right? Well, a lot of people have done that with Carvana. We're now at 56% of float. Float is the number of outstanding shares that can be traded. 56% of those are borrowed and resold. So imagine when Carvana gets any good news and starts moving up, the people who are expecting it to go down now start to panic. Why? Because what happens if you had sold that Lamborghini at $300,000 and the value went to $400,000 and you're holding it short? You've lost $100,000. What if it goes to $500,000? Now you're down $200,000. What if it goes to $1 million? The point here is you have unlimited risk to the upside and a finite number of amount of money you can make to the downside. So when it starts going against you, what happens? You're probably going to panic and say, I can't take these losses anymore. I'm buying it back. I'll take the $200,000 loss here. Here's your Lamborghini. Take it back. Same thing in the stock market. When prices start shooting up, what are these people doing that are borrowing? They're losing a lot of money. The only way to end the pain is to buy and add to the upside. You got to buy your shares back. Remember, you borrowed and sold. In order to close out your position, you have to buy. So look at the chart. Now, most folks who have been shorting have done pretty well. But what happens during a short squeeze is that you see price start to break out above prior highs. And at that point, anybody who was shorting down here is now starting to feel the pain. And so as price goes up, look at the volume accelerate and look at the price action take off. Why? It's because all the people down here that were shorting, thinking that Carvana was going to go to zero, you know, maybe they shorted at $5. Well, now all of a sudden it goes up to 20. If you shorted 1,000 shares, you sold for 5,000. Right at 20, you have to buy back 20 grand worth of Carvana. You just lost $15,000. You just want to make the pain go away. And the only way to do that, it's kind of the flip of being in a bear market. Think 2009 financial crisis, think 2020 pandemic, when prices were going down and you saw your count dropping. What do? Most people, they panic, they sell, usually at the wrong time. Same thing happens on the upside with short squeezes. Now look at what Carvana's doing right now. Look at the volume picking up. Now, I don't know what Carvana is going to do. You know, these short squeezes usually end and they're painful on the way back down. These are not stocks that you buy and simply hold forever. These are stocks that you buy, and when you make some money, you get out. That's what I do anyway. I'm not buying them on fundamentals. I'm not buying them because I like their website. I'm buying them because I think that there potentially could be an insatiable amount of demand and a limited amount of supply. And when that happens, massive volume and parabolic rises, many times one-fold. Now, I don't know if we've topped on Carvana, because people always ask me, when do you sell a short squeeze stock? That's a great question. When you have a profit would be my answer. Now, you know, what do you do if you get in and it goes back down? Well, it's risky. I'm not going to tell you anything different. Trading short squeeze stocks is risky. What happens if you waited 5 days and said, you know what, this thing's really taken off. It's at $18, $19. I'm going to jump in and ride this short squeeze. Look how painful that would have been for the next 2-3 weeks. You know, if you got in at 20, you'd have been down 60% on your investment in 3 weeks. So these aren't slam dunks, and you got to have the mind of a gambler to be in short squeeze stocks. If you don't have that kind of mentality, don't get in. Otherwise, you're going to be saying Tom's the worst person in the world. He told me that this was a short squeeze stock and I lost 40% in 3 days. Hey, that could happen. You've got to go into these stocks knowing that this is money you can afford to lose. And if it goes your way, be thankful, take your money and run. So I'm in Carvana right now. I traded it yesterday. I actually got out at a pretty good time yesterday. Let me show you the intraday chart yesterday and why I got out. So I had gotten in on a pullback. I don't know where it was, maybe around 1150, 1160, but it went all the way back down here and hit this 1130 area. But do you see this? Every 10 minutes, it was putting in higher highs, higher lows. And it wasn't until this second one right here I got out. So once it kind of showed that it was potentially starting to reverse, I said, that's enough. I'm not taking a chance. When it went all the way down here and flattened out, I jumped back in. I think I got back in around 1180, right about where we closed. This morning, actually last night after the bell, it was down 50 some cents. It was 1130 something. I was like, oh, well, here we go. And then I get up this morning. The news was pretty good on the inflation, and this was up. I don't know where. Now we're up 30 cents. I don't know where this stock goes today. I wish I did. Wish I had a crystal ball. If it can break back up above this high from yesterday, then you've got potential panicked shorts covering. Here in the middle, it could be shorts, trying to build up more position. They dig their heels in. You know that feeling when the market's going down and you're like, I'm going to get some more. I'm just going to buy some more. This is ridiculous. It's gone down too much. So you buy more to lower your average cost, and then it keeps going down. Eventually you sell and take a huge loss. Shorts do the same thing. So they're going to dig their heels in. And if this breaks out, that could be really painful for the shorts. To the downside, one thing to watch is just the daily lows. If this thing were to go down below yesterday's low, I guarantee you I would be out. I don't know if I'd wait that long. But certainly moving below yesterday's low is not an indication of a short squeeze at that point. So anyway, I wanted to point this out. Short squeezes are pretty wild. And like I said, we do the research for our members. This chart list gets updated every 2 weeks when the new short data comes out. And, we go back, we adjust it, we send it out. Members can then download it into their account, or they can just view the charts. But you can see that it's in order. Novavax was having a big day yesterday, 45%. Another one that I own is Vuzi. I bought yesterday, And what I always do with these short squeeze stocks, I buy small positions. If my normal position is X dollars, I probably divide it by 3. Normally, I won't take a short position that's more than 1/3 of a normal position because they're so volatile. If I lose money, I don't want it to really hurt my portfolio. But sometimes these can move enough where even with 1/3, you get a stock that goes up 30, 40%. 1/3 of that's 10%. That's good on a normal position. So yeah, I just want to keep my positions a little light. But VUSI I bought yesterday because look at this candle. Look at the volume pickup yesterday. And it broke out. Anybody who has shorted VUSI in the last 2 months is underwater. They're losing money. And if this thing continues to go up, it's going to put a lot more pressure. And if it ever gets back up above 6, all of these, anyone who shorted in the last 7 months is underwater. Anyway, shorts are pretty cool. But we are at 9:30. I wanted to show you this consumer price index chart. I said I was going to talk a little bit about inflation. So I'm going to, this is how you can pull up the core CPI on stock charts. $, CCPI, core consumer price index, $, CCPI. Now this is a daily 1 year, but it only changes once a month. So daily is kind of crazy. We want to switch that chart to monthly. PPO doesn't matter. We don't really worry about PPO of the inflation. Accumulation distribution is NA. What we eventually want, though, is we want to have the rate of change, 12 months. And let's go back 10 years. 12-month rate of change. And then I also like to pull up a 1-month rate of change. And we'll put the S&P 500 on here as well. And just let's do these. The height. Don't need volume. All right, let's see what this chart looks like. So here are the CPI readings. And you can see in 2021 when they started going up. So that's when inflation began to really pick up on a year-over-year basis, certainly month over month. Here is the 12-month rate of change. And you can see how that picked up. And the interesting part is when inflation went all the way from 1.5 to almost 6, the stock market, the S&P 500, was at an all-time high. It wasn't until we hit this level that we had the 6-month, 9-month cyclical bear market. One thing I had pointed out long ago about inflation, my studying of inflation, is that when the inflation level peaks, you not only want to be in stocks, but you want to be in growth stocks. Now, we peaked back in September, I guess. Would have been the August CPI data that comes out in September. That was the peak, and the market actually topped a month later. So we had a low on the S&P 500 in October before we had the big rally. Now, remember, this shows the low in September or August, but this is a monthly chart. If we pulled up a daily chart, you would see lower lows in October. So at the high in inflation, basically, we were pretty close to the low in the S&P 500. And what I kept telling everyone was that as we started getting more and more CPI report data in, we were going to be losing these extremely high readings and replacing them with much lower readings. And so I said that, and this was back when inflation was going up, I said, I think we're going to peak in inflation around March. And the reason I said that was because this right here was the March CPI that had spiked to almost 1%. Because what we were looking at in March of 2021 was where we were versus March of 2020. Well, we know where we were. Pandemic, right? So demand CPI went crashing down. The rate of change went crashing down. Now, a year later, it's the opposite. And so that sent inflation soaring. And what I said was a year later, all those incredibly high readings would start getting replaced with lower readings. Well, we ended up going up one more time, basically a double top, but that was essentially it. As far as I'm concerned, we're dropping now. Unless you see this month over month spike again significantly, if we keep coming in at 0.4, 0.5, 0.3, and especially I'm waiting for the first drop below 0.3 because I think that's when the market is going to absolutely explode. Because once that starts saying, hey, inflation's returning back to the 2% level, that's when the Fed's going to get the green light to lower rates. And when they get the green light and they start talking about lowering rates, growth stocks are going to explode. They already have. Market's already, like I said, market 6 to 9 months ahead already has exploded. Just a couple of quick earnings reports. And we can actually pull the chart up. A, B, and B, they were they gapped down, but they held support. I actually think we could see a rally from here. Watch this level. If it closes below about 108, then all bets are off. But the fact that we opened at 109 and change gives me a little bit of hope that we're going to rally off of this open. Next up, Occidental Petroleum reported. Excuse me. They're down, really good support really from here all the way down to 54. I think if you're buying for the longer term, Occidental Petroleum's fine. I'm not a value investor. I prefer seeing a stock that's in an uptrend and trading the momentum to the upside. So, but there are plenty of folks who like to trade based on support. The current price down to 54 would be a great area to build a position. If you lose 54, you end up getting out. But based on the last year, that seems like the support really to watch. Electronic Arts came in below expectations. Stock gapped up, came all the way back down, now starting to rally. But look in the case of this gap up. Did we break above the recent highs on the gap? Nope, just beneath it, which usually is a hint to me that we're going to come back down, which we did in a pretty big way. Wynn Resorts. So a lot of the gambling stocks have been doing great. Wynn actually gapped up, pulled back. This is one that, in my opinion, probably the closer it gets down to about 103 to 105, the more that I would like it. I didn't look to see if they beat on their bottom line, on their top line, but they crushed their bottom line. They were expected to lose 18 cents and they had a profit of 29 cents. That's why we got the gap up. But we didn't gap up above the highs. Ended up coming back down. I think at some point this morning, we'll probably find a low on Wynn. That would be my guess. Exact Sciences. This is a big one, I believe, for Kathy Wood over at the ARC Funds. And if she's still got a big holding here, she's going to be really happy. Stock up almost 12% today. Big move up. Bottom line, they were expected to lose 79 cents. They lost 42 cents. So they lost about half of what they were expected to. I would say that was probably what led to the strong showing here. Anyway, that's it for me. Let's take a look, see what the market is doing, see if the NASDAQ's holding on to the 1% gain. So far it is 1.04%. S&P up 2/3 of 1%. Dow up a little more than 1/4%. The VIX now back down another 6%, heading back down toward the 15s. Right now at 1658. All in all, look at the small caps, by the way. Small caps up 1%. This is a chart to watch too, because if we can get back up above the most recent reaction high, this is a group I think that could really begin to explode. I wrote about it recently, did a video on it, I don't know, probably a month ago, looking for that trigger, looking for that breakout, and we never got it. Hold back, we put in a double bottom. Now it's starting to go again. This is a very interesting area of the market, and a breakout would be very bullish. All right, that's it for me. I appreciate everybody tuning in. Thank you so much for following us on our stream. If you like our video, make sure you click the like button below and subscribe to our channel. We got lots going on. You don't want to miss it. Make sure you're subscribed and tell your friends. If you like the show, if you like the way I look at the market, which I think is a lot different than most folks, and I think I've been right most of the time. If you like this approach, tell your friends, have them come in and watch. I'm telling you what, my goal in life is to help folks achieve their financial dreams. And you can't do it by listening to CNBC. They're always behind the game. They're always telling you what's already happened. They don't look out. They don't look forward. Stay away from those guys. Tune into Earnings Beats. Everybody have a great day. Happy trading.